In the shadow of the 2008 financial crisis, UK house prices embarked on a relentless ascent, surging over 80% since 2009 despite sluggish economic growth and stagnant wages. This boom, fueled by chronic supply shortages and rock-bottom interest rates, transformed homeownership into a distant dream for many. By 2022, a seismic shift loomed. Soaring inflation, aggressive rate hikes by the Bank of England, and recession fears threatened to burst the bubble. Pundits warned of a 1990s-style crash, with house price-to-earnings ratios hitting record highs, over 7 times average salaries nationally, and a staggering 11 times in London. Affordability teetered on the edge as mortgage payments poised to devour 45% of take-home pay at 5.5% rates. Yet, as we stand in November 2025, the narrative has twisted unexpectedly. Instead of a catastrophic plunge, 2023 delivered only a modest 1.4% dip, followed by a robust 4.7% rebound in 2024 and a steady 3% rise through August 2025. Average prices now hover around £273,000, defying doomsday predictions. What spared the market from collapse? Was it resilient demand, government interventions, or simply a softer landing amid global turmoil? As interest rates stabilize and economic headwinds persist, the UK housing saga continues, proving that in property, as in life, predictions are perilous. Dive deeper into the forces at play, from regional disparities to the buy-to-let exodus, and uncover what 2026 might hold. Story: the UK housing market has long been a barometer of economic health, a realm where dreams of homeownership collide with harsh financial realities. Since the depths of the 2008 to 2009 recession, house prices have charted an extraordinary course, climbing more than 80% by 2022 despite anemic GDP growth and even weaker median wage increases. This surge wasn't driven by booming prosperity, but by a toxic mix of limited housing supply and unprecedented low interest rates, courtesy of the Bank of England's quantitative easing policies. New builds lagged far behind population growth and household formation, creating a perpetual shortage that pushed prices skyward. Investors, particularly in the buy-to-let sector, piled in, snapping up properties as yields remained attractive amid cheap borrowing. But 2022 marked a pivotal inflection point. The post-pandemic world grappled with runaway inflation, triggered by supply chain disruptions, energy shocks from the Russia-Ukraine conflict, and lingering COVID-19 effects. The Bank of England, mirroring global central banks like the Federal Reserve, began hiking interest rates aggressively, from a historic low of 0.1% in early 2022 to 5.25% by mid-2023. This shift sent shockwaves through the housing sector. Mortgage rates, which had hovered around 2% for years, spiked to over 6% for some fixed deals, dramatically altering affordability calculations. Prospective buyers, already squeezed by a cost-of-living crisis with inflation peaking at 11.1% in October 2022, pulled back. Zoopla reported a 33% drop in buyer inquiries following the chaotic mini-budget under Liz Truss in September 2022, which briefly sent gilt yields soaring and mortgage offers vanishing from the market. Analysts at the time drew ominous parallels to past crashes. The house price-to-earnings ratio, a key metric of valuation, had ballooned to over 7 times average earnings nationally, surpassing the 2007 peak that preceded the Great Recession and echoing the 1990 bubble. Regional variations amplified the concern. London's ratio hit 11 times earnings, pricing out all but the wealthiest, while the north of England remained more grounded at around 4.4 times. Yet, raw ratios tell only part of the story. Affordability, factoring in mortgage payments as a share of take-home pay, offered a nuanced view. At pre-hike rates, payments sat modestly above long-term averages. But projections for 5.5% rates painted a dire picture. Payments could swallow 45% of disposable income, a level last seen before the 2007 crash and nearing the 1990 highs when rates touched 15%. The generational divide added layers to the debate. Older homeowners reminisced about enduring double-digit rates in the 1980s and 1990s, but overlooked the context. Back then, house prices were far lower relative to incomes. A typical 25-year mortgage at 2% in 2022 might cost £1,100 monthly. At 6%, it jumped to £1,700, a £600 hike that could break budgets amid rising energy bills and food costs. First-time buyers, often millennials or Gen Z, faced not just higher rates, but stricter lending rules post-2008, requiring larger deposits and stress tests for rate increases. As 2023 dawned, the anticipated reckoning arrived, but not with the ferocity many feared. Rather than a 1990-style 20% plunge or 2007's 15% drop, prices fell by a mere 1.4% annually to December 2023, according to the Office for National Statistics. This modest correction was cushioned by several factors. Fixed-rate mortgages, popular since the 2010s, provided a buffer. Many homeowners were locked into low rates for 2 to 5 years, delaying the pain of remortgaging. The economy, while slipping into a shallow recession, GDP contracted 0.3% in Q4 2022 and Q1 2023, avoided deeper turmoil. Unemployment stayed low at around 4%, bolstering confidence. Government support, including energy price caps and fiscal measures under Rishi Sunak's premiership, mitigated the cost of living squeeze for middle-income households. The decline was uneven. London and the Southeast, with their inflated valuations, saw steeper falls, up to 5% in some areas, while more affordable regions like the Northeast held steady or even rose slightly. Buy-to-let investors, who had thrived in the low-rate era, began exiting. Higher rates eroded yields, and new tax rules, like reduced mortgage interest relief, compounded the pressure. Yet, this exodus didn't flood the market. Many sold to owner-occupiers, maintaining equilibrium. By 2024, the market staged a remarkable recovery. Prices rebounded 4.7% over the year, per Nationwide Building Society data, driven by easing inflation, down to 2% by mid-2024. The bank's decision to hold rates steady, and eventual cuts starting in August 2024 to 5%. Wage growth outpaced inflation for the first time in years, restoring some purchasing power. Pent-up demand from delayed buyers resurfaced, and schemes like Help to Buy extensions aided first-timers. Northern Ireland led the charge with 7.1% growth, followed by the Northeast at 5.9%, highlighting a leveling up trend away from overheated southern markets. Entering 2025, the upward trajectory continued, albeit at a tempered pace. Through August, prices rose 3% year-on-year to an average of £273,000, with the UK House Price Index standing at 104.6. Monthly fluctuations persisted. A 0.8% dip in June marked the sharpest since early 2023, reflecting lingering caution amid global uncertainties like US elections and European energy woes. Yet, annual growth edged to 2.4% by October, supported by further rate cuts to 4.75% and resilient consumer spending. What explains this resilience? Supply constraints remain chronic. Despite pledges, new housing completions hovered around 200,000 annually, short of the 300,000 needed. Demographic pressures, rising immigration and household formations, sustained demand. The economy dodged a severe downturn, with GDP growth at 1.5% in 2024 and projected 1.2% for 2025. Austerity echoes under Sunak gave way to balanced fiscal policies, avoiding deep cuts that could stifle recovery. However, vulnerabilities linger. The house price-to-earnings ratio remains elevated at about 7.5 times, signaling overvaluation. Regional divides persist. England's average hit £296,000, up 2.9%, Wales £211,000, up 2%, and Scotland £194,000, up 4%. Lower income groups, hardest hit by the cost of living crisis, are largely sidelined, exacerbating inequality. The Resolution Foundation's warnings from 2022 proved prescient. Real wages fell sharply in 2023 before recovering, depressing demand among aspirational buyers. Globally, the UK isn't alone. Peers like Canada and Australia, with similar booms, saw steeper corrections. Canada's prices dropped 8% in 2023 before stabilizing. The US, buoyed by stronger growth, avoided falls altogether. Economist Edward Lemur's axiom that housing drives the business cycle rings true. Rising prices in 2024 boosted consumer confidence and spending, aiding recovery. A sharper fall could have deepened recession. Looking ahead, forecasts for 2025 suggest 1 to 4% growth, hinging on rate trajectories, inflation control, and geopolitical stability. If rates fall further, affordability improves. Persistent high energy costs or a global slowdown could stall momentum. Long-term, structural reforms, boosting supply via planning, deregulation, and incentives for builders, are crucial to prevent future bubbles. The UK housing market's journey from 2022's brink to 2025's steady climb underscores its adaptability. What began as a potential crash evolved into a soft landing, thanks to policy buffers and economic fortitude. Yet, for many, especially young families, the ladder to ownership feels steeper than ever. As the economy navigates post-Brexit realities and climate transitions, housing will remain central, influencing wealth, mobility, and societal divides. For investors, buyers, and policymakers alike, the lesson is clear. In property, timing and context trump all predictions.